my name is Loic Lemenner, and welcome to the Iron Law of Valuation. I'd like to start by telling you why I thought this video would be useful. There's been an incredible rise in asset prices all over the world. What I find in talking with people is that many of them don't know the nature of the game they're playing with their investments, and their strategy is based on little more than hope. At extremely high and low prices, this can cause people to make life-ruining mistakes. This is my attempt to demystify some of the basics around asset prices so that you can make better decisions for you and your family. The Iron Law of Valuation is simply this, that for a given set of cash flows, the more you pay, the less return you get. So if you think of an investment as just a box that's kicking off, say, $10 of cash to you every year, the more you pay for that very same box, the less return you'll get, and vice versa. Hopefully that's pretty intuitive. Now let's break down your total return into three independent variables. This equation is nice because it's what's called an accounting identity, meaning that it always explains all your returns at all times for any investment. The first variable is growth. So in my investment box example, if that box starts out by giving you $10 a year and that grows to $15 a year, then obviously that box is worth a lot more. The second variable is yield. So that's the $10 itself. If I bought an investment for $100 and it's kicking out $10 a year to me, nothing else ever happens. I'm making 10% of my money. And the last variable is valuation change. So the classic example there is I bought my house for $100 a square foot. I then sell it for $200 a square foot. I just made 100% on valuation change alone. Now, one of the keys to being a successful investor is understanding that these three variables have very different natures. Both growth and yield I'll call fundamentals. You can see it on the company financials. You can measure them. If you're the CEO of a company, you can greatly affect the growth and the yield of your company. The last variable, valuation change, is very different. You always know the price you paid for something, how expensive it was. What you don't know is the price at which somebody is going to take it off your hands in the future. In essence, how much they value your growth and yield in the future is primarily determined by their psychology, how optimistic or pessimistic they were at the time. And that's impossible to guess years in advance. And that makes the valuation change very tricky and very different from the other two variables. Now let's look at this equation to explain speculative investments. I consider speculative investments things that don't make any money. They don't generate any cash. So that would be gold, art, Bitcoin. There's nothing wrong with buying these things, but you have to understand the nature of the game that you're playing. By definition, these things have zero growth because they have no cash flows. And they don't have any yield either for the same reason. So the only way you can ever make money off of speculation is by guessing at what the valuation change will be. And that's a really tough game to play when literally the only way to make money is to time it a little better than the next person. The analogy I like to use is to think of stocks, bonds, and speculations as buckets. The stock and bond buckets are getting filled with trillions of dollars of earnings and interest, while the speculation bucket is staying bone dry. Now, that doesn't mean you can't make money off it. It just means that you're playing a completely different game with a different set of rules. Now let's move on to apply our equation to the stock market, and I'm particularly going to try to stress how predictable some of these variables are. As a crude proxy for the growth of the stock market, I'm going to use GDP growth, which is simply an approximation of the size of the economy. If you look at this chart over time, you can see that economic growth is fairly stable. Yes, it dropped meaningfully during the Depression, but then we had better than average growth for a decade to get us back on trend. When we think about the next decade, I think most economists would tell you that 1% a year growth would be terrible and 3% growth would be wonderful. Short of economic disasters, which can happen, it just doesn't move around that much, especially when you're thinking in 10-year increments. Let's move on to the yield of the stock market. Here's a chart that shows the dividend yield of stocks along the horizontal axis and the valuation of stocks along the vertical axis. What you find is that yield is very well behaved if you take valuation into account. So when stocks are cheap, you get a nice 7 or 8% yield on the right side of the chart. And when stocks are expensive, yields can really suffer. Said another way, the amount of money paid as dividends doesn't move around a ton. It's the price you pay relative to that stream of cash flows that dictates your yield. True to form today, when valuations are at their highest of all time in the US, we have a dividend yield approaching a measly 1%. Our last variable is valuation. I like this valuation metric because it looks at the stock market from four very different angles to give us the blue line. The thick red line is the average over the last 122 years. You'll notice that the blue line, how expensive or cheap the stock market is, moves around a lot. There is no fundamental reason why this line should move as much as it does. What you're seeing here is human emotion, confidence, and fear being extrapolated indefinitely into the future. If you look at where we are today, we're at the highest prices of all time. Let me reiterate here that we know where we're starting with valuation, but we have no idea where we're ending, how optimistic or pessimistic people will be when we go to sell. That makes valuation change the doozy variable that is highly unpredictable. So what can we do? The first thing we can do is look at history. Jeremy Grantham, who is maybe the world's foremost bubble expert, gives us this statistic. Since 1900, there have been roughly 30 major developed world stock market bubbles. How many of them would you guess not only stopped growing, but made it all the way back down to average valuations? 10, 20 of them? The answer is every single one. There isn't a single exception. Today, if the S&P 500 were to fall all the way back down to average, that would imply a loss of over 60%. That's not very encouraging, is it? The second thing we could do is use our trusty equation to do some forward-looking math. Everybody always likes predictions. For growth, like I said, a great decade would be 3% and a terrible decade would be 1%. So let's take an optimistic view and let's call it 2.5%. Now, to get a gross of inflation return number, you got to make an assumption for inflation, which I'm using 2%. Now, you might say, oh, Loic, inflation is a lot higher than that. Your number's too low. And I agree that if recent inflation persists, our gross of inflation growth number will be a lot higher. But logically, mathematically, and empirically, inflation is very brutal on valuation. So if you want to make a higher growth assumption solely due it to inflation, be my guest. But then you need to expect valuations like we had in the late 70s or early 80s, which you'll see in a couple slides. For the current dividend yield, we know that for the S&P 500, it's currently 1.2%, not because companies are being stingy with their dollars, but because the prices we're paying is so high relative to that stream of income. We're going to average that 1.2% with an ending dividend based on our assumption that's reasonable. The lower the ending valuation, the higher ending dividend yield I would expect and that I'm going to use in our equation. Which brings us to the doozy factor of valuation change. Since we don't know where we're going to end up with valuations over the next decade, let's look at a range of possibilities. This range covers 97% of history, where from where we are today, 174% above average valuations to 50% below average valuations. The middle column is what that implies for 10-year returns on the S&P 500 if you plug that into our trusty three-variable equation. And the last column is what percentage of the time has the US stock market been at those valuations or better? So that kind of gives you a confidence number of how likely it is that we end up at those valuations or better when you're making predictions. So let's start with a prediction of no valuation headwind, meaning prices stay at these record levels or at least end at these record levels over the following decade. What you find is that you still get a 3% below average return. The long-term average return of the US stock market is about 9% because you're losing about 3% a year to the lower dividend yield. Now, the main problem with this prediction is that we've been at this valuation, at this high evaluation, exactly 1 month in US history. So your confidence level that we end here should be really, really low. It's kind of like playing a game of Russian roulette with 100 chambers and 99 bullets. You would never bet your financial life on such a game. So if you want to have a little bit more humble forecast, let's forecast that we're going to end the decade at 25% above average valuations. Well, now the problem is that you experience a negative 1% return because even though you're assuming the economy is growing and that you're getting a dividend yield, your valuation drop is working against you. And even then, you only have 30% confidence that you're going to end up at these type of valuations or better. So this range of possibilities should be absolutely frightening to you. For contrast, let's look at what those numbers would have looked like in 2009 when stocks bottomed at, depending on which month you picked, at roughly average prices. Well, from the beginning of 2009, if you assumed that we got to record high valuations where we are today, if you had that foresight, you would have predicted a really nice double-digit number of almost 19%. But even if you had more humble assumptions that you just figured we went from average prices to average prices, you would have still made your historical 9%. That's what buying at average prices does. And then even if stock market prices fell to, or I should say stock market valuations fell to 50% below average, you would still eke out a positive rate of return. So obviously this probability distribution is looking a lot better. To finish the exercise, let's look at what the math would have looked like in 1982 when the stock market went through a brutal bear market and nobody wanted anything to do with them. So in 1982, US stocks were trading at 57% below average valuations. So if you had the very humble assumption that that valuations over the next decade would end up at 50% below average valuations, you would have earned a nice 11.6% return on your money. If you had the audacity in 1982 to think that prices could get back to average at some point over the next decade, you'd earn a high teens return. And that's what a probability distribution looks like when stocks are cheap and you're one of the only courageous ones to buy them. The punchline to this exercise is that while you can't know where valuations will be in a decade, you can have a very good sense for how likely a favorable outcome is. These three possible outcomes, these three columns of possible outcomes are night and day from each other, especially between the very cheap market and the record expensive market. Of course, the hard part of all this is that you don't get to extremes overnight. You don't get to record high prices without first going through an expensive market and then a very expensive market. And likewise, you don't get to dirt cheap market without going through a brutal multi-year price decline. However, if you look at the recent past trend as a guide for what you should be doing, you'll be doing the exact opposite of what this math is telling you. And that's exactly what Buffett means when he says, be fearful when others are greedy and greedy when others are fearful. If a huge amount of optimism is baked into the price, you should have very humble expectations. Let's look at how well this math does in predicting the US stock market. This chart from Dr. Hussman plots 12-year returns vertically on this chart, and then valuations are on the horizontal axis. So when the dots are over here in the right corner, the stock market's very expensive. What you find is that within a channel, stock prices are very well behaved, and valuations are a very good predictor of long-term returns. However, what valuations don't tell you, and this is why very few people use them, is anything about the short term. As we've seen the last few years, a bubble can always go further than you thought possible. So what should you conclude from all this? Let me go through a few bullet points of takeaways. One is, remember that gradualism is a wonderful regret minimization technique. My least favorite question to get is, should I be in the markets or not? Because it presupposes that you only have two choices, all or nothing. I would suggest gradually rebalancing away from markets that are getting more expensive and towards markets that are getting cheaper. It never has to be all or nothing. Secondly, lean away from the asset class that has done the best. Over the last 10 years, US growth stocks have blown away every other asset class, but that leaves them now at truly ridiculous valuations. There's something like $14 trillion of stocks trading north of 10 times sales. It's very reminiscent of the 99 tech bubble, and it's very likely to end in a similar fashion when the NASDAQ lost 82% of its value. Have a larger buffer in your portfolio or use a hedge. Given the optimism in prices today, you might consider a larger buffer of safer assets, or if you're lucky enough to have access to a quality hedge, use it. Look for idiosyncratic ideas. I've been spending a lot of my time looking for ideas that I call away from Wall Street, things that didn't necessarily benefit from the prevailing winds of the last 10 years, but are likely to be more protected when this era ends. If this bubble goes from record high valuations to even higher valuations, be willing to look and feel dumb. Unless you can time the market peak, your choices are to look dumb before or after the peak. There's just no getting it perfectly right. And for the love of everything you hold dear financially, do not look at the last few years as evidence of a new paradigm. We have hundreds of years of financial data across dozens of countries. If you're betting on something that has never happened, you're very likely to be disappointed. And with that, I thank you for watching and good luck to you.